The risk of moving jobs, I don't think is anywhere near as big as everyone thinks it is. I just had this feeling that my parents-in-law just thought I was terrible at my job. They were like, what has our daughter married into?
Do you think this sort of rise of protectionism and, tariffs and global fracturing, has that been a challenge for you in scaling these global consumer businesses?
No.
What was in your head? How were you quantifying that risk of I'm throwing away a lot, like a really golden path?
Trying to remove financial risk comes with risk of never really knowing what you could have done. And those two things have always like eaten at me. At one point they had Floyd Mayweather in the restaurant, and that was murder.
Friend of the pod, actually.
Yeah, exactly. Yeah.
Most of finance that does sustainability, in my opinion, is rubbish. For you guys, how you managed to get it so right, whereas a lot of people just get it really wrong?
Really, the story of the business is the story of the founders, not the slide deck that they put together for their investors.
Ladies and gentlemen, welcome back to the Mergers podcast. We're in a new place today because Gaz has flown off to America and left us behind. But with us as ever, Ken, how you doing?
Doing good. Ready to laugh around a bit.
Yeah. Very nice, mate. That's really tickled me. That's a terrible joke. It made me laugh earlier. Gaz sending us that thing about our videographer's got his first NDA and he was sweating.
Yeah. I was like,
just sign it and get the work.
Just sign it. Yeah. No one cares.
They're not enforceable anyway. But yeah, so anyway, if you're a VC firm looking for work, Gaz now has 3 or 4 firms under his belt. So
names we know.
Names we love and know, but now can't say. And with us today, the man who's giving Ken a run for his money, Jon. For those that don't know you, the founding partner at Eka, just closed £100 million Fund 2. Fund 1 is doing absolutely stellar with a huge exit already. You've done unicorns, including Interactive Investor, Mubi, Gousto, a huge win with Bloom & Wild as well. Thank you so much for coming on.
Thanks very much for having me along. Looking forward to chatting everything through.
No, absolutely. Look, I've sort of tried to give you your flowers, as Gen Z would say, and sort of explain, a terrific record in terms of picking unicorns, especially within, European market. But do you want to maybe take us through the early days and sort of, what took you to Oxford and then what took you out of engineering and into VC, which is a fairly different career to the safe and steady engineering?
Yeah, sure. So I did engineering at Oxford, mainly just because at school, I guess I was pretty narrow in terms of what I was good at. I was basically only good at maths and physics. And so engineering was the obvious choice from that. Enjoyed it, but I wasn't one of those people who came out of the degree and was like, I want to do this. It was more, still wasn't totally sure and ended up going to JP Morgan to work on it was a sales desk that sold interest rate derivatives to hedge funds. So basically it was like what would be called a flow desk, as in, you get in the morning at 7 a.m., you sit waiting for the phone to ring, like hedge fund phones you pick it up, you trade, and then that's kind of what you do until 6 p.m. and then you leave, and it's always 7 a.m. till 6 p.m. was like very exciting as someone as a 23-year-old. It was a great team. There was 12 of us. It was really fun, but it wasn't, I think it became quite clear to me that it wasn't what I wanted to do forever. I think there's an obvious path there. The guys that were 10 years older than me that were doing basically the same thing as me, but just with a lot more money or bigger clients. And at the same time, I think that's when I just kind of started to click into actually what do I want to do? Sort of started to see the next 10, 20 years as a career rather than just the fun of life of being in your early 20s. And at that, so this is 2006. And back then, that was when Tesla was just kind of the Roadster, which was basically Lotus chassis with a big battery in it, had just been launched, and I was fascinated by that because it was clear to me that it was just. I thought it was better than a petrol car. I'm not someone who's massively into my cars, so I was like, well, it accelerates faster than a petrol car. Its range is good, good enough for virtually everything. It looks cool. And then at the same time, the other end of the spectrum, driving around London, we had these tiny little cars called Revas, which was an Indian electric vehicle make. And they were like, 2-seaters, people would use them to commute. But also had some like real benefits to it. And so I started researching that EV world and found venture capital as a result of researching that world. Like I didn't know it existed. Didn't really exist in London, to be honest. Draper, DFJ had backed Tesla, was like publicly announced it. And so I started like emailing them. Weirdly, I had very little money. I was emailing them to see if I could make like £1,000 investment in their fund, which is obviously like the most on reflection, really stupid. I never got a reply, but in email I was like, right, well, I better find who else is doing this. And then that I discovered the venture capital world. And then the weird thing about working in an investment bank is that the structure, the pay structure means that you kind of almost get most of the money that you're going to get in the year in January. And so you kind of have to, you don't want to do half a year and then decide you want to leave. If you're going to leave, you leave like at the beginning of the year. And so I just decided that I wanted to go into venture capital. And going back to that, like I was the job I was in, I had to be in at 7, leave at 6. I literally had to ask to go to the loo just in case the phone call rang. So it's not conducive to going doing interviews with VCs at all. So I was like, the only way I'm ever going to, and there were no jobs in VC. So I was like, the only way I'm going to get a job in VC is if I make this my full-time job. And so quit at the beginning of 2007 with no real sense of what was about to happen to the world. Like if you look at my CV, I could tell a story of like I realized that the financial world was about to collapse and I needed to go long term and all this kind of stuff. But that wasn't what happened. I was just like, right, I want to get into VC and left.
I'm kind of fascinated by this like shift in role, because on a flow desk, you're not really taking risk, right?
No.
You're just processing flow and taking the spread. So you've got a really uniform job. You know the hours of absolute grind during the day, but pays pretty good, let's be honest, for a 20-year-old. You would have been doing all right. Not taking risk and just getting paid to execute. And then you're like, actually, I want to go explore my curiosity in electric vehicle revolution in San Fran and stuff. Like, what was in your head? How were you quantifying that risk of like, I'm throwing away a lot, like a really golden path?
There's a pattern here. We'll come on to talk about like the transition from MMC to Eka. But I think actually there's two parts to it. One is I think I wanted to move into taking risk and reflecting. I thought about whether or not I could move to a hedge fund. I thought about whether or not I could move within JP Morgan into the market makers and that kind of thing. So I definitely had this feeling of like wanting to be that side of things. And then I think the second thing is I just, the risk of moving jobs, I don't think is anywhere near as big as everyone thinks it is. Or if you define risk, if you were to define risk purely financially, then it is. But if you define it also as like opportunity risk, then I think the risk of staying where you are is the biggest risk. Like it's, the idea of like exploring what you're capable of, I think is kind of the most interesting part of work. And so I think trying to find out what you're capable of comes with financial risk, but trying to remove financial risk comes with risk of never really knowing what you could have done. And those two things have always like eaten at me.
That's quite a like philosophical approach, like from an early age to understand that you don't want to arrive safely at your grave with a big bank account, never having done anything. That's still like quite an old head on your shoulders to see life that way.
Yeah, I think so. I mean, me and my wife just describe it as like blowing stuff up because she's done she did something similar a few years after I left JP Morgan. So she was at a big American law firm in a really steady role and then had left to set our own business up. And I do think there's this like, you have this like stability, and I think the stability actually thought about in a different way can be kind of scary, because you do see that if you can see too far ahead of you, I think that can be for me from a career. Weirdly, in my like home life, I'm completely the other way around. Like I like to be able to see like miles ahead, but in work, I find that like that more risky than anything else.
Yeah, to be fair, I remember at one point, like within a year of being in my first grad job at like Evelyn, one of the guys turned to me and was like, "You're partner material. You could be here for life." And I was like, "What?" Like,
I literally had the same thing when I just joined HSBC. They kind of introducing us to the team, and this person was like, "Yeah, so and so's been here for 30 years," and I was just like, "Huh." I need to get out of here.
Yeah. Okay. So let's go onto the transition of then you're leaving JP Morgan and you went to MMC, right?
Yeah.
Which, again, for those who don't know, one of like sort of Europe's top VC funds, incredible track record, including Synthesia, BotGuard, like unicorns across tech and consumer, which you did. That talk me through the journey, because you end up, spoiler alert, managing partner. But talk me through that journey of climbing the ladder and I guess the framework you built for finding these unicorns.
Yeah. So well, I mean, I joined there when it was really small. It was mainly an angel syndicate at that point in time. So beginning of 2007, it had some EIS funds on the side, but the majority of capital was angel syndicate. And there was so there's the 3 founding partners. And then there was I think, team of 3 people basically finding deals and investing.
So your $1,000 LP ticket was actually respected there.
Yeah, well, yeah. I mean, the investors were a bit bigger than that, but it wasn't totally like out of the question. And I was an analyst. I was like the most junior person in the team. It was a little muse house. Like we would, the person who joined after me, we had like make the IKEA furniture for them to see. It was like had a real startup vibe to it. And VC back then really was tiny, and it was a very, very different vibe to where it is today in terms of, deals would come to you, you could take your time on them, like you'd write massive DD papers and all of this kind of stuff. And then what happened there is, the great thing about joining a very small company is when people leave, you tend to get promoted because that's just what happens. And so between 2007 and 2010, the 2 people that were more senior to me both left. And so I then ended up running the investment team. We hired some awesome people that have gone on to do, well, the whole alumni at MMC actually has gone on to do like great stuff within venture. But there was a moment where the investment team was me, someone called Tracy Dorey went on to found Kindred, and Roy Sterling, who's now a partner at Connect. And that was a kind of bit where MMC started to transition much more into like a technology focused investor. And that's when I started to lead my first deal. So 2010 was when I did the first 2 deals. Second one was Interactive Investor, which is one of the ones that went on to sell for $1.7 billion a long time later.
And that was seed or Series A?
That was a strange deal. It was, I would call it a Series A, but it was, so that at the time when we backed it, it was mainly a media company. So the company does retail fund management or stocks and shares online. Yeah. And at that time, it was actually a news platform for like information on trading for retail for consumers. And then we backed it to bring the trading bit in house. And so it was bigger. It'd been through several evolutions, actually, weirdly. It'd actually been through the .com. But yeah, I'd call it a Series A in terms of tickets. It was like let's say it was a £3 million round kind of thing. And then, and so develop, I guess over the next 5 years, developed a much clearer view on the kind of investments I liked making, learned how to run a team, got more involved in the operations at MMC, became a partner, I think, in 2012, or it's a company, so director in 2012, and then co-managing partner in 2015, alongside Bruce McFarlane, who's the founding partner that kind of has run ran the firm from the beginning.
He's still there, isn't he? Still involved.
Yeah, he is.
I met him a few times.
Yeah. The two, so Alan Morgan and Bruce McFarlane still, definitely when I was right through my time, were really involved in the business, and they've done an amazing job of building like a very cool platform. And the other thing I think that they did fantastically well is bring very motivated, smart people into the organization, and then create an environment where they just got on and did stuff. And when I joined, they were in my case study interview when I joined MMC was looking at the pitch deck of a company that someone who just left was starting, and then they invested in that. And so a guy called Ricky Knox, who went on to start Tandem Bank, and there's just like loads of cool people have come out of that business. So loved it. Went all the way through, and then had this. I mean, I can go into more detail, but core belief that I wanted to start a new venture fund, and so did that after 11 years.
Ricky Knox is an interesting guy, but it'd be interesting to know. You kind of mentioned figuring out the kind of deals that you like. Obviously, very good track record on consumer type stuff and consumer deals. How did you say, consumer was going to be the deals that you wanted to back? What is it about that? Because obviously we have that Tesla aspect, or you wanted to do the 1,000 ml peak ticket. How did you say consumer is my space, and how have you seen that kind of evolve since you got started in venture?
Yeah, so I just didn't. It wasn't as strategic as that. Because I also about 50. It was about 50-50 B2C, B2B, and actually that's not too dissimilar to what we do at Eka. But the differentiated bit was the consumer bit, because less people were interested in it, and then at the consumer deals ended up being the big return drivers. Having said that, if you looked at it if you looked at the track record in the halfway through, so let's say like 5 years in, the exits had all come from B2B companies in the kind of 2 to 5x bucket, and some really good companies in there. So I think that mix was really powerful. Like, you had some solid early exits that enabled you to kind of hold a bit longer in the bigger outcomes. And then on the consumer, I love backing a company where you can actually have a view on, like a personal view on the product. Mm-hmm. There's kind of something about it that is really engaging. And it's also, when you talk to people about it, people ask what you do as a VC. And if you go into some deep tech B2B company, you can see people kind of glaze over. Whereas if
Ken spent a year, if not two, trying to explain some of these companies to me, and I'm like, nice.
And it's not to say they're not interesting. They are interesting. It's just they're not, but if I described a Gousto or a Bloom and Wild to people either love it or hate it. And quite often they've had it and they're like, oh, you did Gousto. I had some a crap recipe from them the other day, so they must be a terrible business. There's actually quite a funny story from when we did the Gousto deal. So my wife was a lawyer, became a chef, and her family are all massively into cooking. Her parents love it, and very particular about what they'll eat and how they cook and stuff. And we were renovating our house, so we were living with them at the time we were doing the Gousto deal. And I ordered a Gousto box to their house, and then got stuck at work and I couldn't make it back to cook it. So it arrived at their house and they were like, well, we'll cook it as a family, the three of them. And it was a disaster. It was just not a good meal. And this is really early days of Gousto, they're still shipping from their bedroom kind of thing. And I got back and you could tell they were like, oh, I'm not sure about this company, because the chili doesn't taste very good. And I was like, oh God. Anyway, ended up doing the deal, and for a long time I just had this feeling that my kind of parents-in-law just thought I was terrible at my job. What is the what has our daughter married into this guy who thinks that this is a good idea? Obviously it worked out, and now they and we had 2 weeks later we had a Gousto box and it was awesome. But this feeling of so that's the great thing about consumer. Everyone can engage with it, have a view on it. It makes sense.
And I guess as well, what are you looking at for early stage consumer deals? Obviously you can try the product, right? You can try Runner, you can try, Gousto box both times. But what do you see is like the difference there? Because obviously I have to feel like the bar is a bit higher. There's probably a quality and founder, like why are they doing this? But what are you looking for typically?
Yeah, so we do both consumer and B2B at Eka, but in the consumer side, I just think that there's almost like a load more moving part. Everything's moving faster, and you have like rather than having you're a tiny business, but you have 10,000 customers, and the kind of the sort of surface area of things that could go wrong is almost bigger as a result of that. Comments online or like little like edge cases in the product. So I think as a founder, there's probably two, massively overgeneralizing here, but two things that really stand out. One is just pace of decision, and like quality of execution. Those two things together, like excellence at speed. And then the second, I would say, is just kind of bravery to really put yourself out there, and using examples to explain that. So Runner, which is a really good success story for Eka. You've got Dom, who has this unbelievable ability to execute like extraordinarily well at speed. And then you've got Ben, who just deeply understands the industry, has this desire to tell people about it, the mission means a huge amount to him, and he's not frightened of taking some risk with getting that message out there. And that's this I actually think now we're seeing that more and more in B2B in the way that you see companies market. Like the founders are out there all the time. And it used to be that you could kind of hide behind the B2B veil. Now you can't.
Do you think, out of interest, this sort of rise of protectionism and, tariffs and global fracturing, has that been a challenge for you in scaling these global consumer businesses? No, actually. I mean, we haven't done a lot where they have a complicated physical supply chain. Okay. So the digital ones, obviously, it doesn't really impact them. They tend to be focused on the US very early anyway, and it's pure play digital, so it's a bit different. I think with the tariffs, if you're shipping stuff around the world, which quite a lot of consumer businesses are, then it's challenging. But it's sort of challenging for everybody. So I often think like when you're backing early stage companies, because maybe it also this is true because Eka's so early in its life cycle. So our portfolio is pretty early. Like you kind of industry shakeup is kind of helpful because you are more nimble. Like if you're working in clothing, say, or like that, and you're competing against $10 billion turnover businesses and their supply chain gets messed up, well, you kind of know who's going to be able to change price quicker, who's going to be able to like move factories quicker, who's going to be. It's probably like actually net a bit of an advantage to have a big shakeup. Once you get to 10, 20 million of revenue, that then maybe flips because you don't have the leverage with your suppliers to be able to say, no, you're not giving me that 30% cost. You're going to take 15% of it. We'll take 15. But yeah, we've got a couple of businesses where they do have a physical supply chain, but they navigated it really, really well. And it wasn't a problem. That's actually quite an interesting way to look at it because I can see the point you're making about the upheaval creates opportunity, which is in a way why I almost wonder VC's been a tough place to raise money in the last few years. But it's almost like with so much uncertainty, maybe the only safe option is to go back to businesses of the future and take a risk on the up and comers rather than try and pick the bottom in Disney or Restoration Hardware or something. Do you know what I mean?
Yeah. I mean, we definitely, I've always struggled throughout my career to talk about macro, to like get too excited about macro economics, because I'm fascinated by it, but as in like in the way that we invest, it's like, okay, well, we're investing now in this tiny business. And if it's one of our like really good ones, we want to hold it for a really long time and sell it in 10 years time. And in 10 years time, I've got absolutely no idea what the like backdrop's going to look like of the economy, but that's when it matters. So you kind of like it. The bit where I get nervous about the kind of backdrop is on the way in when it feels like everything's just kind of gone a bit crazy, and I've experienced that a few times through my career where I'm just like, this just doesn't. These prices don't feel right. The kind of behaviors don't feel quite right. But everyone is making money doing it, so should we be doing it? Like you feel like maybe you need to start chasing. That's where I've always felt like the most uncomfort in that. Okay. Yeah, and then there's a bit of that today. It was probably most acute in between the second half of 2020 through to the second half of 2021, where it just looked there was some stuff going on and it made no sense. But people were making good money from investing it in those businesses. So you're kind of thinking, well, maybe we're wrong, not them.
Ken, how did you navigate that?
Well, I was in a very well-funded fintech at the time, so I think
that was before your VC days.
Yeah. But even then, I was when I came back from New York, to here, I started working in fintech, and we had a 75 million Series A, and I was like, I'm no VC and I'm new to this kind of stuff, but I'm not really sure how they came to this number. But then I got flown to Greece, so I was like, oh, it can't be that bad. So yeah, it was a very interesting time. But I think I agree with AI stuff. I mean, but I think it would be good to get your opinion on this as well. Like you have these larger funds that at the earlier stage are paying for optionality, and a lot of these deals might be cookie cutter in a sense, but they're still kind of high. So if you're if they're paying for optionality, but you need this to kind of have an outcome of some degree, some surrounding error for you, could be existential to your fund. So how do you kind of navigate that these days versus before? Maybe it's a bit different, but maybe a bit of the same as you said. But how are you kind of looking at these two times differently?
Yeah. So in that question, you mean like this is not a company we've invested in. This is like competing in that situation.
Correct. Yeah.
It's hard. It's hard. I don't really have a good answer. Like we ran the numbers on Fund 1, and most of the investments, so 70% of the investments we did, there wasn't a competing term sheet. Mm-hmm. So a lot of the time, for whatever reason, we like stuff that other people don't. Yeah. And at the point that we invest, if you like stuff that other people don't for a long time, then that's a terrible investment strategy. But because you can't raise any follow-on capital. But if there's like a moment in time where you have a point of view that you think is going to change over the next 18 months, it does. And that's like, if I could describe Eka's difference, that's it. Like I think, and we've proved that. We have data that really shows that, both in terms of exits, but also awesome follow-on rounds. I think that, but that's not to say that we don't compete, because we do. And I think I just don't like, it tortures me. Because there's two things that are true but conflicting. One is ventures driven by the outliers. So if you say no to a company on valuation and it happens to be the outlier, then that would have been a massive miss for you.
Right.
And then two, the valuation, your in-price valuation really affects your outcome. Right. And so if you go in, yes, you'll have a good outcome, but it might be like not half, like return half the fund rather than the fund or something like that. And so that actually, I think if you look back at, there's a benchmark fund that did Uber that is one of the like famous VC funds. But if you look at the price that they did Uber at, and you looked at the price they would have to do Uber at today, that fund would be probably half as good as it was. And so, yes, they would still do that deal, but their overall returns would be half as good. And I don't know that, I don't have a good answer to that. I think you just have to.
No, that's fair. And I guess you touched on it a little bit, but to be more direct about it, how are you, at those early stages, how are you managing, I guess, consensus and non-consensus deals, and then balancing your own conviction in that? Because you can say, you can have the 18-month view, but 18 months is a long time as well. So how are you managing that?
Yeah, I was going to say, do you want, because we kind of like skipped onto the way that you run money, but this is, do you want to explain as part of this answer, like the way you at Eka approach and the way you have like the founder assessments and that kind of stuff?
Yeah, sure. Yeah. So we invest in two themes. One we call consumer health. It effectively is this idea that we're going to shift from a very reactive healthcare system to a more proactive one over the next 20 years. And there's going to be lots of opportunity for technology to shape that, lots of value created. And that covers health and well-being at one end of the spectrum. It covers early diagnosis, early treatment at the other. And we invest in that theme. Believe it's going to happen. Second thing we invest in, we call sustainable consumption. What we mean by that is let's look at our really big consumer supply chain. So like how food, travel, home, fashion kind of things. And if you look through those supply chains, how do we make those supply chains more resource efficient and less carbon intense? And the outcome of that is going to be lower cost, better supply chains that also have a lower environmental footprint. So we're looking for companies that fit that. So we've kind of set our stall out on the thematic level, like that's what we invest in. And then our job is to find incredible founders who share that view. And that means that we can be very, very people-led in the way that we invest because we've kind of done the idea work. Like we believe these two things are going to happen over the next 20 years. We want to find people who share that belief. And then we spend a lot of time on understanding founders, and really the core of that is it just surprises me that more people don't do this, but they don't, and that is so very early on our process we say to founders, look, we want to stop talking about the business and we're just going to talk about you, and we're going to do a one-on-one with each of you. I spent yesterday afternoon doing this. Hour to hour and a half conversation, very similar to the questions you asked me. Go right back to childhood, walk us forward to today, talk about the big moments in your life, big decisions you made, the hardest things you've dealt with. And if you do that with a founding team of 2 or 3, the amount you learn is unbelievable that you don't get from someone pitching product to market. And really the story of the business is the story of the founders, not the slide deck that they put together for their investors. Yeah. And so we do that. We do actually do a psychometric alongside it that helps us kind of figure out when they describe their life, why those things might have happened. And then we also do a lot of referencing, and we're really structured in the way that we do referencing. And then we pull all of that together and are looking for consistencies across it. And that is going to your question on conviction. That's how we build conviction. And it's not necessarily that we think people are like good or bad at being founders. It's just have they got the skill set we think they need to deliver on the business that they're building. I think you get this sense of people that you just deeply want to work with. And actually, when I lost a deal at the end of last year, and it still hurts because I just really enjoyed spending time with that founder. I really enjoyed the way he described the business that he wanted to build. I thought that what he'd experienced in his life and his kind of skill set worked really well for that business. And then I got the offer really wrong. And I've learned a lot from it, and it meant that they went with someone else. And I just genuine feeling of I just felt sick about it. And I think that's when you have this I want to do this deal, and that's what you're looking for. I mean, lots of people in the venture world describe it as if you're not a hell yes, you're a hell no. Yeah. But it's difficult. Is a great soundbite, but very difficult to turn into a process.
Out of interest, going back to, I won't press you on the deal you lost because that's just mean.
Well, you mean you can, and I don't mind talking about it. It's just it was interesting to me that reaction of almost physical reaction I had to losing it.
Okay, yeah. But so go on then. We'll go into it. What was those takeaways? Was it just the way that you structured the deal, or was it more you learned something about yourself to listen to your gut feel, your intuition more?
The big learning for me on that was I didn't spend. I think I was a proper conversation on what the founder was looking for in the structure of the deal, away from being able to win the deal. And we had a slight lack of flexibility in mind. So actually, it wasn't valuation; it was ticket size and ownership. And I think we could have just been more flexible on that, and then we'd have still felt really good about the outcome. You just go in cycles in venture, because on fund one, big learning for us was the businesses where we had meaningful shareholdings are actually the best performing businesses, which is great, right? Like that's how it should be. But then it's not all the portfolio. So then we're like, okay, well, the thing that we need to do is just to make sure on fund two that we're really focused on meaningful shareholding. And then you can kind of take that a bit too far in terms of like, okay, well, we're not going to be flexible on let's see if we can get this new like 10 to 20% target that we've got. And then you're like, you don't quite get it because it's not to do with valuation, it's to do with ticket size. And then, you miss a deal and you're like, no, hang on a minute, that isn't venture. Venture's more flexible than that. We want meaningful ownership, but we need to be ready to be flexible to get into back founders that we really want to work with.
Yeah. Okay. So it's that constant optimization of zigzagging your way to the perfect framework.
Yeah. Without breaking the model. That's the like, goes back to that feeling of like, there's inconsistent, there's two truths that are totally at odds with each other. Like, yes, it's an outlier business. Yes, valuation matters.
Yeah.
I did have a question for you on Eka and the way, again, you approach these deals. I suppose there's sort of two. Number one, how important, we've spoken about this before, that repeated showcasing of talent. And you gave a really good example when we spoke last about someone to do with football. She was a football and then the burger. That's quite a good story. But then also on, can we talk about that and then we'll do sustainability and then we'll, I guess, begin to wrap it up.
Yeah, sure. So one of the things that we're really interested in when we're talking to founders or doing the founder assessment is just their patterns of outperformance and doing kind of extraordinary things that require you to go to the next level. And the example you're referring to is Merva, who's the founder of Hive, which is a logistics business. When we did the founder interview with her, we found out stuff that we wouldn't have found out if we hadn't done the interview, which was around when she was at secondary school. She did very well academically. At the same time, she was captain of the Man City girls football team, so playing football at a very high level and in a leadership role. And at the same time, she ran the social media strategy for her uncle's burger restaurant called Archie's. And if you go and look at Archie's online, look at their social media, they at one point they had Floyd Mayweather in the restaurant, and that was Merva.
Friend of the pod, actually.
Yeah, exactly. Yeah. But Merva, aged whatever she would have been, 16, 17, just came up with a strategy for getting him to actually to come into the restaurant, and then he put it on his socials, and you take yourself back to that age and you simply can't imagine doing that while also, I could maybe imagine one of those three things, but all three together, no way. And stuff like that, I think is just, we're just looking for these signs that people have this different way of going about things.
The next question before we go on to I guess a bit more just career advice and advice to listeners is one thing Eka has at its core is like sustainability. And I'll say it so you don't have to. Most of finance that does sustainability, in my opinion, is rubbish. It's like greenwashing, or it's been so poorly done. But for you guys, it's actually like a genuine source of your success. And I just wondered how you managed to get it so right, whereas a lot of people just get it really wrong.
Yeah, I think it's those themes. I think it is. I think if you went, right, we're gonna build a venture fund, like impact venture fund or whatever you want to call it, and then you were like, right, let's find out if this. Every time you see a business, you're like, is this an impact business or not? Then you just pull yourself all over the place, and I think the outcome of that would be there's lots of different like negative outcomes of that strat. Like you could end up greenwashing, or you could end up like being not commercial enough in the way that you invest and all of this kind of stuff. Whereas for us, it's like, we think that there are, if you actually sat back and wrote, like, what are the 5 biggest questions that like society has to answer over the next 50 years? And one of them is going to be, how do we solve the rising chronic health issues, rising costs in healthcare, rising inequality in health, because and the reason that we need to solve that is societal, like it's important to people, but it's also like deeply economic. If we don't fix this, like the biggest, so the US spends something like, it's a crazy amount, like 10% of its GDP on health. Like it's crazy, and it's got to fix it, otherwise it breaks. So there's an impact and an economic outcome in that. And you could articulate exactly the same thing in environmental. And so it's like, okay, pick a theme where you can see the connection between economic and societal need, and pick a theme that is deeply important. Like if you ask anyone, name the 5 things, most important things that can happen in the next 50 years, they would, unless they were a climate denier, they would have those. They would have those 2 things in it, and so that's like, then you can say, okay, let's find people who are building businesses that are part of that puzzle, like they slot into those themes, and then I think you can build a VC that has impact at its core, but is deeply commercial and competitive in the way that it operates.
One thing I quite like about this is, coming from an econ background, I almost think we're trained to think like too linearly, and it really frustrates me in markets which are just very like almost fractal in nature, or just it's way more complex than just this does this, this does this. And it's like, it seems like your engineering background or your VC background, it's like a very different approach to solving this problem. Whereas if you took an economist, they'd tell you with great certainty how to solve the healthcare problem with a really simple solution. And then when it didn't work, they'd tell you exactly why it didn't work and what to do to fix it. Whereas VCs just seem to be more willing to be like, that's a load of nonsense. What we're going to do is shift the whole model to preventative healthcare rather than reactive healthcare. And it's a very different approach to just like, well, if we increase immigration, we can increase the tax holder base, and then we can, deregulate it a little bit. And these minor adjustments will give us more money and more freedom. Whereas you guys are just like, no, we're going to change the entire model and go over here.
Yeah. Yeah, and I mean, the right answer is going to be somewhere between, because I think the things that VCs get wrong is we massively underestimate the kind of the friction of change because of regulation and like consumer attitudes and all of this kind of stuff. But yeah, I mean, it feels like there are some things that are kind of obvious, and like changing from reactive to preventive healthcare is kind of obvious, and yet hard to do for all sorts of different reasons. Like it's if you could press a button and get to it, it would be obviously better. But the problem, without going into too much detail, but the problem with like, if you went out and just ran massive diagnosis tests against the whole population, you wouldn't then be able to afford to treat what came out of there. So it's sort of like, you don't have it. Well, at the moment we spend 95% of our healthcare budgets on treating people when they're sick. In reality, it should be the other way around. But if we just flipped it, the whole system would break. So you kind of like, it's going to take a long time to get there, which is why I go back to like, what's obvious if you put a 50-year, 25-year mindset on, and then like, okay, it's going to take some time to get there, but like, let's figure out how you make money on the way.
Okay. Yeah. I'm kind of looking forward to seeing some of these products that come out where, you can just get a scan or a blood test and sort of begin to manage that shift yourself.
Yeah, but it does. I mean, I've had the experience personally of you do it and then something comes out and you're like, like the answer to that is not perfect. Like you know, how are you going to, it's very likely to be totally benign, but then you've got to go into the system and it turns out it is benign, but you've just like, it's not, there's lots of stuff like that, which the system needs to work through.
Jon, conscious of your time. So would like to just end a little bit on career advice and maybe the way you see the world going, because we get a lot of messages from grads who are like, what do I go into? And it's become a harder question to answer almost as time goes on. But I suppose we'll start with like, and you touched on it before, but advice to people who maybe late 20s, early 30s, getting that itch at a big bank, being like, maybe there's more, or even people way more senior, I was going to say your age, apologies.
That's fair enough.
But who, have wife, kids, and they want to take a risk and they're like, oh, it's got a good salary. How do you approach those decisions?
Yeah. Well, yeah, I mean, I guess I've taken a big risk in both of those situations. I think on the younger one, I go back and I didn't need to do it when I was that age, but now you do. And that is develop like a really strong interest and point of view in something and publicize it. Like that's my advice. I get asked that question a lot. It's always my advice is, okay, you want to go into VC, like why do you want to go into VC? What is it within VC that's particularly interesting to you? And then go and like you can do that in your spare time, like write about it, read about it. Or if it's the network side of VC that you're interested in, go and do a podcast or like work at like a conference. You know, like you've done it, right? Like there's like, okay, I want to do this, but I could approach it whereby I go down the normal job route, or I could approach it where I'm going to develop something that's unique about me, and then use that as a way of like getting to know people, or we're just hiring at the moment, and the difference between someone who applies and is like, I've done these things that are connected to venture, and someone who doesn't, despite the fact they're both in effectively the same role, is very like valuable, basically. And then at that age, I think there is a lot less financial risk than people really appreciate. But I think by going after like building a point of view and a reputation with the market before you move, if you can't move, then that creates the bridge that you need. And then I at an older age, I personally just approached it like I would a startup. Like I had a cash runway, we had a cash runway, and we needed to have like raise the fund before we hit the end of the cash runway. Okay. It was pretty terrifying. But at the same time, raising a venture fund is so unbelievably hard. I'm not actually sure I could have raising a first venture fund. I could have done it without the pressure of like, okay, well, if you don't do this, then you don't have any money. So I kind of got to send those emails.
Put in the work.
Yeah.
And I'm just interested in, as your career progressed, have you seen sort of similar power law in like your network as well as your deals? Because I weirdly, sort of since we spoke about you doing this podcast, I met two of the founders that I think you're on the boards for, Francesco and Dom, Runner. And it always seems to me that there's an inner circle within an inner circle. Does that ever stop? Is there?
Yeah. Well, in terms of meeting people, like
the networking, and also just like, you know, you sort of see in the family office world, you meet your first family office and you meet another and a bigger one and a bigger one. I just wondered, at your lofty heights, if it ever stops, or are you just always networking and meeting new people?
I think you're always networking and meeting new people. I am. It's if I have a like thing that I worry, I'm not good at the. I enjoy building relationships where there's a thing that's getting done, and I struggle to do. There's a lot of VC networking, which is like meet for a coffee, talk about like what's interesting, and I struggle with that. I struggle to prioritize it, and not because I don't think it's important, just because I'm much better at like if you looked at the network of VCs that I've co-invested with, it's really strong. If you look at my network of VCs that I haven't ever done a deal with, it's much weaker than other VCs. So we think, how do we solve that as a firm is a question rather than how do I solve that personally. But that building of the network, the most valuable bit there is follow-on capital for your portfolio. Like you really should be able to say, okay, you're raising, here are the most interesting funds that you should talk to. So if I have a paranoia, it's like, how do we get better at that, basically?
And then just curious, if you had some advice, what would you tell younger Jon? And also what would you tell the younger students, who are at university and being like, seeing an ever-changing world?
There's three different paths people are talking about at the moment. They're talking about AI fueling huge growth, which creates lots of opportunity and jobs, and it's like exciting. They're talking about AI being another technology wave in the same way that we've had technology waves before. So, increases productivity and growth and changes some industries. That's also exciting. And then they talk about AI removing all the jobs.
Yeah.
I think if you spend a lot of time on that, you probably end up missing all the opportunity in the first two. Because if that happens, it happened. I don't think that's going to happen. But if you did the okay, well, I'm here in 10 years' time, these three things are going to have happened. There's two where you have real agency, which is the first two. And so focus on where you have real agency. And it might be that you think you have agency in the third, which is probably more political and regulatory and stuff like that. Well, if that's what you would think, then go and do that. But like, focus on where you have agency and like be extraordinary at it. And that's my like number one. That's what we do at Eka. That's what like if you get too locked in the like, oh my goodness, this is going to happen. It's the same if you're investing. If focus where you can affect things that are going to drive value rather than worrying about things that you can't control. Which is a cliche, but it's so true.
No, that does make sense. If you take that sort of doomer mindset, even if it comes through, either way you've lost, so you might as well play to win and hope you get a good outcome.
Yeah.
Whereas if you just admit defeat on day one, then it's going to be a tough few years.
Yeah, I mean, and just to be clear, before I sound too, I've got we won't go into it now, but a clear point of view as to why I don't think that is going to be the outcome. But alongside that, it isn't, unless you think that you can come up with a way of stopping it and you believe it, that's important, then focus on areas where you see other really important things and you want to be a part of.
Okay. And then to round it off, a little twist on the, the classic, your biggest mistake. I wondered if there was a company that you wish you could have invested in, but it just wasn't sustainable. Maybe Palantir came knocking one day or...
Yeah. I don't actually, I honestly don't have, I don't have one where we saw it didn't fit with the thesis, and we don't spend any real time on companies that don't fit with the thesis, if you see what I mean. So we kind of, we haven't had one where we spent a load of time on it, got really excited about it, but decided it didn't fit with our like impact mandate. But that's should be because we like the way that we think about the world. It obviously doesn't fit from day one, so we don't spend any time on it. There's businesses where we didn't do them, and I think I really wish we did. I mean, there's probably the one that is most aligned with our thesis. There's a company called Linda's Health, which is in clinical trials, like. Helping to make that a much, much better process using modern technology. And that is like an awesome business. And I think when we met them a bit too late for the fund. And I would, that's a business that when I think about Eka and what we've looked at over the years since starting, I would love for us to be a shareholder in.
Linda's Health.
Yeah.
I'll look for the IPO.
Yeah. It's a great company.
Well, Jon, thank you for your time. Eka has been one of the most successful stories I've come across in years. Basically a fund returner already for Fund 1, which is unheard of. The portcos in Fund 2 are phenomenal. I just can't wait to see what happens from here. But thank you so much for coming on.
Awesome. Thanks very much. Really enjoyed it. Cheers. Great to have a chat with you both.
And everyone, please like and subscribe for more. Thank you very much.